Hello and welcome back to my channel. If you're new to the channel, really the goal of these videos is to simplify terms and strategies and situations when it comes to swing trading stock options. So in today's video, I'm going to dive into what exactly call options and put options are in the context of swing trading for beginners. Okay? So let's say there's a new movie being released, and the cinema is running a special offer in the lead up to this new movie. The option is that you can pay a non refundable booking fee of $2 now, also known as the premium in the world of trading options, which would give you the option to purchase your ticket for $10. So it's a guaranteed price, the strike price, before the new movie is released. Okay. The cinema, and the reason the cinema is offering this is because, they don't know if the movie is going to be a blockbuster or a flop. So they're trying to offset some of that risk by giving you this special offer. Now, if it's a blockbuster, they're going to increase their ticket prices above $10. Okay? It's just the natural supply and demand. If it's a flop, aka demand decreases, then they're going to decrease their ticket prices below the $10 strike price. Okay. So the option to buy, aka the call option, the ticket, which is the underlying asset in this scenario, for $10 strike price, expires one day before the movie is released as part of this offer that the cinema is proposing. Okay. And the option to sell, which is the put option, the ticket, again the underlying asset, expires 7 days after the movie is released. So let's go through a few scenarios. So scenario one, this is the worst case scenario. Okay. So let's say that everything looks good 2 days before the movie is due to be released. Okay. At this point, you've already purchased the special offer. You've paid your $2 premium, the booking fee in this scenario, for an option to buy the ticket, call option, for $10. So you decide to exercise your option to buy the ticket for $10. A few more days pass and the movie gets released, and unfortunately it turns out to be a massive flop. Okay? The ticket price crashes to $5. So what you do is you decide to try and recover some of your losses by selling your ticket to a friend for $3. Okay? That way they save some money from buying at the box office. But overall you would still lose $7 from buying the ticket and $2 for the special offer to begin with, the premium. This gives you a total loss of $9. So if we look at scenario two, which is kind of like the medium case scenario, let's say you paid the $2 fee, again, the premium, as it's known in the world of trading options, for the special offer to buy the ticket, have the call option for $10, 7 days before the movie was due to be released. But 2 days before the movie is released, some scandalous event happens about one of the leading actors. So you decide not to exercise your option to buy the ticket for $10. And this is completely fine. It's completely legal. It's completely aligned with the agreements of that options contract, since you have no obligation to buy it. Okay? Whenever you're making that initial purchase, you're only paying for the option to be able to buy it. Okay? Super important. And this reduces your risk massively, by the way. So all you lost in this case was the $2 premium aka the booking fee for the special offer to buy the ticket to begin with. Okay, to have the option, to buy the ticket to begin with, the call option at that guaranteed rate of $10. Okay, so not the worst case scenario, not the best case scenario. Okay, we still lost money though. So the best case scenario is, let's say you think this movie is going to be a blockbuster again. Okay, so and again, 7 days before the movie is released, you pay the $2 fee, the premium, to guarantee a ticket price of $10. So you have the option to buy it in the lead up before that contract expires. 2 days before the movie is released, you decide to exercise your option to buy, which is the call option again, the movie ticket for the $10 strike price. 3 days after the movie is released, the reviews are positive and momentum starts to gather. Okay? So at this point, we're in the money because the ticket price has now tripled in value to $30. So you decide to exercise your option to sell your ticket, the put option, to a friend for just $20. This saves them $10 from buying directly at the box office, and you secure $10 in profit. Minus, of course, the $2 premium for the special offer, which is the option contract to begin with, leaves you with an overall profit of $8. Okay, so hopefully you found these examples helpful and easy to understand. I know these topics, when you first hear them, puts and calls can kind of be confusing. So yeah, that's really my goal with these videos, is to use these analogies, to use these stories to really simplify them and make them super easy to understand and then eventually implement. So yeah, that's all for today's video. I'll see you in the next one.